Hi everyone, welcome to ACCA Management Accounting. Today we want us to look at alternative costing principles. Alternative costing principles. So this topic is key. Most people, they don't start this one when they are going to write the MA exam, but you have to practice it. These are the basics of performance management F5. When you'll be doing F5, the first topic that we do, those are the topics. You will do ABC costing in detail, target costing, lifecycle costing, and total quality management. But on MA, we are not going to look at the workings. So on F2, you have to know the theory part of it. It's very key, very important, right? So make sure you know the stuff. So let's start with ABC costing, right? So ABC costing, this is called activity-based costing. Activity-based costing. So there was a method that was introduced before ABC costing. So before ABC costing, they introduced absorption costing, and I'm pretty sure that you've heard of this absorption costing, absorption marginal costing. Marginal costing, we say that this is a method which focuses on the variable cost, right? Then the absorption costing focuses on what? It focuses on both variable cost and what? And the fixed cost. It focuses on both. Yes. So this method is good. So then why was ABC introduced, yet we have a method which considers all costs? Why was ABC introduced activity-based costing? The issue was that most companies nowadays, they are now providing services. Most companies are no longer, most companies, they don't manufacture. So if you look at the manufacturing companies, the type of costs that they have, which are significant, the direct material, direct labor, direct expense, and any other cost. That's what I call DMDOTE, right? If you look at these costs, they are significant in manufacturing companies, right? But most companies nowadays, they are now providing services. So if companies provide service, it means the cost that they will incur, which will be significant, it will be the indirect cost. So this is the direct cost. So now, yes, absorption is okay, it's fine, but absorption doesn't focus on the indirect cost, which is also called the overhead cost. Do you follow? So we now need a method that focuses on the indirect cost, and that method is called what? The activity-based costing. So that's why ABC was introduced. Yes, that's why they say, number one, ABC is a form of absorption costing. You'll be given questions. They'll ask you, which of the following is true about activity-based costing? Number one, just know that it is a form of what? Absorption costing, right? So it was introduced after ABC. Yes, it focuses on both. Since it is a form of absorption costing, right? It's a form of absorption costing. Number two, since it's a form of absorption, that means it also considers that both the variable cost and what? And the fixed cost. Yes, sir. So if they say activity-based costing focuses on the variable cost only, that's incorrect. You get it? Right. So it focuses on both the variable cost and the fixed cost. Sir. I can give you some of the examples on activity-based costing. So since this method focuses on this cost, it means it is most applicable when we have high levels of indirect costs, when we have high levels of overhead costs. It's very key. You can use this method when we have high levels of indirect costs, which is the overhead cost in proportion to the total cost. So you have your total cost, but if the overhead cost, the indirect costs are significant, use this method. All right? I can give you an example. We have the cost pool and the cost driver. So if you are talking about the cost pool, this is a collection of overhead costs that are driven by the same factor. So I can give you some of the costs. We can talk about the purchase cost. And you have to know the appropriate cost driver. cost driver, the one that is affecting the cost. So the cost driver of the purchase cost obviously is the number of what? Number of purchase orders. So if you place more orders, it means the purchase cost will increase. So this means number of purchase order is a cost driver. It will affect our costs. Another example, I can talk about machine running costs. Machine running costs. What can affect this cost is the number of what? Number of machine hours. You might set up your machines, run your machines for 5 hours. You incur what? Those machines, they will depreciate, number one. Number two, let's say maybe you're using generators, so fuel cost will increase, right? So number of machine hours, if you increase the number of hours, what will happen to the cost? The cost will also increase, meaning the number of machine hours is the appropriate cost driver for this cost. It does affect this cost. You can incur even the setup costs. You want to set up your machines, it now depends on the setup cost. I'll ask you a question, what do you want to produce in total? So we can talk about the number of production runs. What about the delivery costs? Delivery costs, obviously, is the number of what? Number of deliveries, primary school thing. So that's activity-based costing. We move on to the next method. Next, on our summary, we do have the target costing. We have the target costing. Target costing. Why was target costing implemented? Why was it implemented? Most people in the businesses, what they do is, the first thing, before they charge a price, they consider the cost that they have incurred. First thing, for example, someone might purchase a certain product at a cost of $10. $10, this is the cost, right? They don't just start by charging a price, they consider the cost. Maybe you're buying and selling products, maybe you might purchase a certain product outside or from different suppliers, right? So the first thing that you consider is the total cost that you have incurred for that product. Then the second thing, you ask yourself, right, yes, I have incurred 10, how much am I expecting as the profit? How much do I need to gain on this product that I have incurred a cost of 10? Yes, then you have to set your profit, which is called the markup. That's why people say, I want to add my markup. I need a markup of 25%. I need a markup of 20%. Depends with the profit that you want. Let's say you want a profit of 5 USD. So if you want a profit of 5 USD, number 3, that means you then have your selling price. Do you get it? So obviously, you then sell your product at how much? You incur the cost of 10 and you want to gain $5. So for you to be able to gain 5, so that means you're going to charge the selling price of $15, right? Yes, you will receive 15 US, then you know that you've incurred 10, so your profit will be 5. So that's this is not target costing, this is traditional. This is traditional method, what most people do in their business. But then target costing was introduced after this. Let's say, hang on a minute, there is a problem somehow with this method, with the traditional method. This method is good, yes, we all know that there is no way you make a loss. For example, let's say even the cost of the product, even if they increase the cost, maybe the suppliers, they are saying, yes, our product, we know that we used to sell at $10 to you, but now we've changed the price, we've revised the price, we are now charging 18 years. You yourself, if you want a profit of 5, what will be your selling price? You just adjust, right? If you want a profit of 5, your selling price will be 18. So are you seeing that on the traditional method, there is no way you make a loss? The challenge with the traditional method is one, it does not encourage cost saving. That's the problem. It doesn't encourage cost saving. You don't care about the cost. You don't care even if the cost increase. You don't even care. So even if they increase the cost, you tell yourself that I'm also going to increase the selling price. You get it? So you also increase the selling price. So this method doesn't encourage cost saving. The other thing is the cost might be too high, which will cause your selling price to be too high as well. So if your selling price is too high as compared to the competitors, people won't buy the product from you. So yes, you have the profit based on your calculations, based on what you are expecting. Yes, you might record that if we make sales, we will definitely get some profits. We'll make something out of it, right? But it will be difficult to get that profit. It will be the profit in your books, but not in hand. So now, that's why target costing was introduced. It says the first thing that you need to consider, it says, no, people, let's change the order. Let's change the order. Right. The first thing that you need to set is the selling price. Which selling price? Which is the market price. The first thing you consider the selling price, which is the market price. Just consider what other people are charging. What are they charging? You look at what other competitors are charging, which is the market price, right? Number two, you look at the profit, right? So what's your profit? Your profit, that's the margin, the amount that you expect to get. Then number three, that's your cost. So target costing changed the order. So the first thing they said, you have to consider the selling price, what other people are charging. So if other people are selling the product at 15 years, you have to also charge 15 years so that you'll be able to gain a certain market share, so that you'll be able to have more sales, right? Then the second thing, if you want a profit of $10, 5 years, for example, for argument's sake, $5, that means your cost must not exceed what? Your cost must not exceed $10. That's it, right? So that means you are saying, I'm charging 15 years what other people are charging, but I need a profit of 5. So for you to be able to achieve the profit of 5 years, your cost must not exceed the 10 years. So that means this will be your target cost, the cost that you are targeting. You get it? So that's the target cost. But just know that things not always move as we expect. So you might have set a target of $10, but the cost that you might estimate as time goes on, it might change. Have you ever seen someone starting, you want to start a certain module, you start with much energy, right? Telling yourself that I want to get 80%, right? But as time goes on, you might change what you are estimating. For example, you might say, what I only need is the pass mark. I only need 50%. Do you get it? So that's what happens. You might set a target of 10 years, but things might change. You might, for example, even the suppliers might say, want to increase the price, the transport cost might increase, other costs might change. So the cost that you are now estimating, the estimated cost, the projected cost, they might change. For example, you might say, I don't think we can only incur 10 years. Maybe it's likely that you are going to incur $13. Imagine if you incur 13 and you are now selling at 15. That means your profit will be $2 instead of the 5. Do you follow? So you now need to look at the cost gap. So the difference between this target cost and the projected cost, it will be the cost gap. Meaning there was a cost gap of the cost you were targeting is now different with what you're estimating. So there's a difference of 3. So this is not good. This is a cost gap. So you have to make efforts to close that cost gap. So how do you close the cost gap? There are so many ways to close the cost gap, so many ways to reduce the cost. So you need to review the breakdown of the cost. Maybe look at the direct material, the direct expense, direct labor, look at other variable overheads, other fixed overhead costs. Look at them and try to reduce the cost. For example, if it's the direct material, reduce the number of components, right? If it's the direct material, try to cut out non-value added items. There are some of the things that doesn't add value to your product, but you incur the cost on them. Reduce those things. The direct labor, may try to use cheap source of labor. Not only that, maybe they are not efficient. They are wasting more time. Yes, they are taking more time to finish, to complete a product. So what do you have to do? They need more training, right? So that they will be more efficient, so that they will be able to save time and to save resources as well. All right, so that's target costing. So those are the steps that you should follow on the target costing, right? Easy. Then we move on to the next thing. That's number 3, life cycle costing. So on the target costing, they might ask you a question that on the selling price, which price do they consider? Is it the market price or the desired price? Market price. The market price or the desired price is not the one that you desire, but the one that is in the market. So you have to set the price that other competitors are also using, right? That's it. Then on the life cycle costing, nothing much. They will ask you a question, how many stages do we have in the product life cycle? We do have 5. So why 5? Most people, they don't consider, most people, they just start with the introduction stage, forgetting about the research and development stage. We have the research and development stage, we have the introduction stage, we have the growth stage, we have the maturity stage, we also have the decline stage. Right. So research and development stage, we are focusing on the cells that we have. Research and development stage, we do have losses here. This is when you research about your product. You research. When you talk about the research, you're acquiring knowledge. The process of acquiring knowledge, development, you're now applying what you have acquired, the application of the research findings. So research, you're only developing. You are not yet selling a product, so you start with the research and development stage. Then from the research and development, you move on to the introduction stage, where you introduce your product into the market. But normally, the sales will be very low. The sales will be very low. Sales will be very low on the introduction stage. But as time goes on, you might be able to attract customers. You might be able to get volumes. So you end up reaching the growth stage. So the growth stage, this is the initial stage where of making the profits, because you can't say you are now making the profits in the introduction stage. So on the introduction stage, you have not yet recovered the research and development costs. Because most of the costs that you incur, which are significant, they are incurred on the research and development stage. You move on to the introduction, you move on to the growth stage. Growth stage, this is the initial stage where you make profits, and also sometimes you'll be able to charge high selling price where you need to recover your cost. Yes. Then from the growth stage, you end up reaching the maturity stage. Maturity stage, where we say we have the highest sales volume, where you'll be able to enjoy the economies of scale. You are selling your product to many customers, you are selling your product to many people. Yes, the reason why you make a lot of profit on the maturity stage than the growth stage, it's not because you are charging a price that is too high, but it is because of the number of people who are buying from you. So the product, if it reaches the maturity stage, we start to say you've enjoyed, you'll be able to make more profits. But from the maturity stage, but just know that you always reach the decline stage. Yes, but it doesn't matter if it takes time to reach the decline stage. It doesn't mean that the decline stage is inevitable. It doesn't mean that the decline stage is unavoidable. You always reach the decline stage. Alright? Yes, even as human beings, we are all going to reach that stage, the decline stage, right? Right, so the decline stage is inevitable, right? So we have 1, 2, 3, 4, 5. Yes, sir. So if the product reaches the decline stage, it means it's no longer in the market, right? For example, we can talk about Nokia. It reached the decline stage, right? Yes, sir. So those are the 5 stages that we have on the product life cycle. And if they ask you a question, so on this stage you incur losses, right? And on the introduction stage, you have not yet recovered the profits, so you are still incurring the losses. But on the growth stage, we have profits here, maturity, profits here, decline stage, losses here. That's it, right? That's the life cycle. And about the cost, life cycle costing, they will give you a question and say, which of the following costs are included in the life cycle? Just know that they include all costs. So the answer that you select is all of the above, right? So life cycle costing consider all costs from the research stage to the abandonment of the product. It considers all costs, whether it might be the inventory cost, production cost, marketing cost, research cost, design cost, marketing cost. So we have many costs that are included in the life cycle costing. So this method is good because it considers all costs and considers the revenue, the total income. So it helps you to assess the overall profitability of the product. Get it? So that's the life cycle costing. Then the last thing now is total quality management, is TQM. Total quality management. Yes, sir. There are principles under total quality management that you have to know. When you are talking about the total quality management, it means our aim is to improve our quality. Total quality management. What we want is quality. We need products of good quality. Total quality management. So it has some principles that we follow. There are some principles that we follow. We talk about zero defect philosophy. We talk about zero defect philosophy. So this method, its aim is not to have some products that do have default. Maybe it's a company that do manufacture chairs, right? That means we don't need defects. We don't need defects. If we say we are giving you this material, we want you to produce 50 chairs, you have to come up with 50 chairs, right? Not to say we do have 5 chairs that have not yet met the quality. We don't accept that on total quality management, right? We want zero defect, right? No room for error, right? So that means total quality management, it focuses on this. Number 2, continuous improvement of quality. And so we are saying we have to keep on improving our quality. We have to keep on improving our quality. Yes. Have you ever seen, yes, people, they do improve. Businesses, companies, they do improve the quality. Yes. You might say we do have maybe on iPhones. People used to say iPhone 12 is the best. iPhone 10, iPhone X, right? They used to say the best, but later on they produced iPhone 13. You get it? So on their side, yes, they might say they've given you the best, but they aim on to improve the quality so as to meet the customer expectations, right? So in other words, they focus on the customer needs. So you call it customer focus. That's another principle of total quality management. And another thing, we are saying no room for error, meaning get it right first time. Get it right first time. Get it right first time. First time you produce, you need to get it right. If you're not so sure that you are going to get it right, you need training, right, so that you get it right first time. If you're not so sure that you are going to pass the exam, you have to study, you have to do questions, you have to do papers right. Until you're sure, then you go to you won't go to the exam until you're sure, right? So get it right first time. So those are the principles that you need to focus on. So total quality management, that's it. Total quality management. Then yes, we might need the quality, but there are some costs of quality. We all need this, but there are some costs that you have to incur for you to be able to achieve this. So we have what you call the conformance costs. The conformance cost. Number one, the conformance cost. We do have the prevention cost and the appraisal cost. So one example of prevention cost. We want to prevent. You want to prevent prevention cost. You don't want to fail the work. So prevention. What do you do for you to prevent that? You don't want to fail. So what do you do? Training. Training is an example of prevention cost. Before the employee produces these units, train the employee first. So as to prevent making losses, right? So as to prevent producing product of poor quality. You have to prevent. How do you prevent? You train them first before they start doing the job. Number two, you can give them the machines that are more reliable. Yes, that's what you do. Number three, you can also hire people who are skilled, who you know that they'll get it right first time. That's the prevention cost. So for you to get it right first time, you incur a cost, and that cost is called prevention cost, right? Then we also have the appraisal cost. Appraisal cost, it means, yes, you might allow them to just do one or two, but you have to test. So you're incurring the testing cost. Yes, the testing cost, you incur a cost. We can talk about the testing cost, the performance cost. So this way, for example, you might say, you have your employees, but you're not so sure that they're now good at their job. So can't we just supervise them? Supervise them, right? So you are testing whether they're getting it right? So that's a cost. They might fail, yes, but you might correct them. So you are incurring a cost. So you want to confirm first before they have completed the job. That's why these are called the conformance costs, right? Then the last thing, we have the non-conformance cost. Right, non-conformance cost, this is when people fail the job. So that's why we have the word failure. If it's internal failure, if someone fails, what can you do? You can redo, right? So an example of internal failure is rework. If they say rework is an example of which costs 1, 2, 3, 4, rework, you have failed, you're doing it again. So it's an internal failure. Alright? But if it's external failure now, this is more serious. If it's external, the word external, it means you have failed, but it has not affected outsiders. You have failed, but it has not affected even the customers. So if you are given the word customers, it's an external failure cost. For example, imagine you going to shop and you see you purchase a certain product that is expired, right? So it means this is not good. Yes, customers are going to complain, right? So customer complaints is an example of external failure cost, where the business has failed. But if they fail and if they redo the work, it's internal. But if it reaches, it is going to affect the customers. It's an external failure cost. Example, customer complaints, marketing errors, selling product that is expired. Those are some of the examples of external failure cost. That's total quality management, where you say the process of applying zero defect philosophy to the management of resources and relationship within an organization as a means of developing and sustaining a culture of continuous improvement of quality, which focuses on customers' expectations. That's it. So that's alternative costing principles. Thank you very much for your time. See you in the next lesson.